Good afternoon, everybody. First up this afternoon, I have great pleasure to introduce Doug Ramshaw, President of Minera Alamos. Doug, please.
Short and sweet. Good afternoon, everyone. Okay, so Minera Alamos is a gold developer. We have a little bit of gold production, but in essence, we're always developing. We're always looking at building our next mine. We specialize in low capital intensity builds. That was a smart decision, I think, 3 years ago. It's even smarter now when we're seeing a lot of Capex blowouts. The team's done it before. We've been in, I should say, I'm going to make a few forward-looking statements. As customary, it's important to read them and put in context what you hear in presentations. I urge you not to read them during this presentation. It will take you probably the first 10 minutes. We've worked in Mexico for 14 years. We like Mexico. There's a lot of noise that we've seen about Mexico in the last half of Mr. AMLO's term. So much noise, in fact, that most people's opposition in the past, if they're pro or anti-Mexico, is because of the cartels. I haven't had a question about the cartels in Mexico for 3 years. That's just how noisy the AMLO government has been. But Mexico is a fantastic jurisdiction. It has a good, clean permitting process. It focuses on you engaging at the social license level right from the outset. You can't permit without it. It's been slower in the back half of AMLO's term, but things are moving again. We saw just last week Torex Gold get a permit amendment. There are a few others that are in the hopper, including one that we're waiting on. And Mexico offers one, I say the three biggest challenges facing the industry. I used to say it was two, water management and permitting. I'd add to that skilled labor shortages. Mexico has an abundance of talented people. There's a real mining culture in Mexico. So despite some of the headlines which would make you think that Mexico's becoming another Venezuela, Mexico's open for business. And I think we'll see dramatic change, especially after the next federal elections next summer. So we have one operation that's up and running. It's having some teething problems, but it was a $10 million build. Again, specializing in that low Capex build. We built a mine in the middle of the pandemic for $10 million Capex. Our next one is a $25 million build. We've got a funding package all lined up for it. It's waiting on permits. And to put in perspective, Cerro de Oro, our second mine, we could build 6 times over just for, a Marathon Gold's cost overrun. Not their Capex, just their Capex overrun. So these low Capex builds are very insulating for a lot of the pressures facing our sector right now. We have a strong balance sheet, about 20 million in working capital, 0 warrants. We haven't had a warrant on a financing in the last 4+ years. And yeah, a multi-mine strategy. And the plan is to build out the first mine. That supports taking a bit of debt on to build the second and so forth. And as you sequence these mines, you can grow a production profile, which in essence is going to hopefully look something like this. Santana, can get up to about 20,000 ounces a year in its first iteration, which doesn't sound like much. It spits off about $8 million US in free cash flow a year, just at a 20,000 ounce operating rate. Cerro de Oro should be built sometime next year upon receipt of permits. We have the funding package in place, 0 equity dilution for that. So the funding is in place, so there's going to be no nasty surprises for our shareholders there. Can get us to about 80,000 ounces a year. And these are sub-1,000 AISC projects. So although the industry is suffering right now in $2,000 gold prices, $2,000 gold is a very healthy gold price. I think what it's exposed is a lot of very unhealthy operations. So we think we're in a position to really capitalize. We're not going to be servicing debt for years and years and years. So when we're generating operating cash flow, it's really there to reinvest in the business, not pay off debt for years on end. I used to say that we were industry leading in our capital intensity, and then I had National Bank produce a chart which kind of shows the typical range of projects is somewhere between $1,500 and $3,000 an ounce of Capex against the production profile of the project. We're down at $500, $600, $700 an ounce typically on these projects. So absolutely industry leading in that regard. It's a very technical team. I think you need a strong technical team when you're building. I wish we had more teams in this industry actually building mines, but it comes with its own challenges. I'm not going to kid anyone that, you know, building mines is an easy path to go, but it's one that I think we can get a great deal of satisfaction out of because we're building a real business. The team, as I said, have been operating for 14 years down in Mexico. Anyone who remembers an old company called Castle Gold, that was largely our team that built it, ran it. Ultimately, it was sold to Argonaut, became a foundational asset for Argonaut. That was a mine that got to 120,000 ounces a year of annual production. It started off as a $7 million build. That was the Capex on that project. So our team's done it before, and we're going to do it again. So roughly 140 million market cap, as I said, about 20 million in working capital. Largely retail owned. We've got some big US generalists in the stock, which I like. They are patient, long-term shareholders. And really our second best asset outside of our operating team has been the loyalty and patience of our shareholders. And I think we've tested that loyalty and patience this last year, along with the rest of the equity market. We made some prudent decisions at our first mine. Here it is. It was a $10 million build, as I say, Santana. We had the financing package lined up from our good friends at Osisko Gold Royalties. Got it done, and then COVID came along. Well, don't let a good pandemic get in the way of a build. We built it in the middle of the pandemic. It was 6 months behind schedule, but on budget, 10 million Canadian. We specialize in building the pads, the ponds, a carbon plant. We're not producing doré at site. It's an elegant way to cut a lot of Capex. Instead of building an ADR and producing doré at site, which would probably double the Capex of this project, you're also going to have to increase your security costs as a result, just out of the abundance of caution. We like northern Mexico, but you still got to be smart. So we deal in loaded carbon. We send loaded carbon to the US, where the gold's stripped, and then out to the refinery. And it's actually cheaper to do that than increasing our operating costs through having increased security at site because we're producing doré. So it's not only a Capex saving, it is a op cost saving as well. And as Warren said, our business consumes a lot of capital, so you really want to spend your capital wisely. I think we do it better than most. But Santana has had some problems. I'm not going to sugarcoat it. Like, we got it up and running. By Q3 of 2022, we were up at around a 20,000 ounce a year run rate. And that $10 million mine kicked off $3 million in free cash in that quarter. But then Mexico, like Southern California, got hit by a 3-year drought. And we were concerned about pushing mining rates when there were question marks on some of the water availability in the region. And we could have listened to the market that wanted production to keep going up and blown a giant hole in our balance sheet. In the end, we decided it was much better to protect the balance sheet, nurse this project through. Water is no longer an issue, and now we're just waiting on a permit amendment. As I say, I'm grateful that we saw with Torex Gold recently a permit amendment come through, and there are apparently a few others on deck, including Orla's at Camino Rojo. So we are seeing Mexico move, just not quite as fast as it used to. I'm actually going to jump through a few slides here. This is Cerro de Oro. This is a game-changing project. It's in permitting right now. We came out with a PEA in October of last year. It's a 60,000 ounce, 8-year operation, sub 900 AISC life of mine. We have a management upside case, which is more like 11 to 12 years at 85, 90,000 ounces a year. It's very similar to El Castillo. It's low grade, but it's remarkably low strip. It's 0.3 to 1 life of mine strip ratio here. So it's a giant earth moving exercise. It just happens that the earth has about, close to 0.4 of a gram gold in it. Very low Capex, 22 million, 28 million, including 30% contingency, and IRR at $1,600 gold price of 111%. Important on this and all our projects, they work in a $1,200 gold environment. They can take advantage of a $2,000 gold environment. One of the problems in our sector, I think, is we build mines that only work in certain parts of the gold cycle. We should be building mines that work at all parts of the gold mining cycle, and ours do. Roughly 800,000 ounce resource. We think we can grow it to 1.5 million ounces. We're actually permitting for that case because we're that confident on it. So we're permitting for twice the pad capacity of the PEA case right now. And the funding package, it was a loan. I did not mind the cost of capital on the loan. It's 15% money. But when you think about it, the cheapest cost of capital maybe you can get is 10 or 12%. I don't mind paying a few extra points to get more flexible capital, especially with the 1-year payback on the project. You're talking about $750,000 of difference in interest on it. And I'll take less covenant-heavy debt package for that. The royalty, because we weren't working with a traditional royalty company here, for people who don't like royalties, they have their time and place. But for a project we know we can get bigger, we wanted to have a buyback on it. So it's a $10 million US, 2.75% NSR. We can buy back 2% of that for $6.3 million US. That's very important when we know we've got that management upside case. The most important thing is it didn't result in equity dilution for our shareholders. This can be drawn down upon receipt of permits, which we hope to have by the federal election break in July of next year. La Fortuna is waiting in the wings. It's actually fully permitted right now. So 3.5 to 4 gram open pit, 6-to-1 strip. And again, it has spectacular economics. This was done in 2018 at $1,250 gold, so maybe it's a 40 million Capex project now. Rather than 26. Sub 500 ASIC, if it's got one problem, it's mine life. We built a PEA around a high-grade starter pit of 5 years. We know it can get bigger. We want to use cash flow from the first few operations to grow Fortuna and build it the right way from the outset. And we're drawing to a close in terms of my timelines. I think we're set to deliver in 2024. The key thing to look for is that pad amendment at Santana. It will allow us to be a cash-generating gold producer consistently throughout next year and the next 5 to 6 years at Santana, which will fuel a lot of internal organic growth in the pipeline. We're looking at other operations that can sequence in behind, because this profile we have right now, this portfolio, can be 150,000 to 200,000 ounce producer. But we don't want to stop there. The real value here is then, after you've gone through all the hard work and building, is like, how can you build the next iteration of the company? So one last thing, just going to say, we're going to bring that same, we have a lost little copper asset in Minera. It doesn't belong in Minera, but it's the same kind of thing that we can do copper with low capital intensity. I believe that copper Capex doesn't have to start with a B. At some point in 2024, we will surface this kind of lost copper project that's sitting in the company and try to show that you can take this low capital intensity approach to copper too. So with that, and a couple of minutes left, thank you for listening today.
Well, thank you, Doug. We do have a couple of minutes for questions. So my first one, what about the cartels in Mexico?
It's funny. For all the open pit mining ban talk, which is not the case, and that same story gets regurgitated every 6 months. The projects that get listed were problem projects before AMLO came to power. Things like Esperanza and Cerro de Gallo and others. They're in environmentally sensitive areas or heavily indigenous areas. It was funny that right at the time where that same article surfaced last year, Agnico invested a huge amount of money in Teck's San Nicolas project, which will be a giant open pit mine. Agnico know Mexico better than most companies, so they're not fearful of it. The fact is, AMLO came into power with the support of both the unions and the cartels. The cartels are actually operating, apparently, I don't know any cartel members, just for the record. They're operating legitimate mine service businesses now. Now, it's not some protection racket. I don't know what they do on the back half of those businesses. I'm sure it's laundering money, but there is actually a legitimate business there. They don't want to see open pit mines come to a close. All the big open pits in northern Mexico are kind of coming to the end of their natural life after 15, 20 years in operation. There's huge amounts of mining unions that want jobs, and they don't want them all in underground mines. So I think it's a big red herring. We're buyers in Mexico. We actually think Mexico is going to revert to the mean, and it's going to be a good jurisdiction to work in. It's certainly low cost, both from an operational point of view and a Capex point of view. And we love the geology down there.
Thank you. And I'll add to that, Mexico directly employs more than 450,000 people in the mining sector, and the current government is making more money from taxes and royalties than any other, from mining, from any other government previously. Okay, that's our time. Doug, thanks very much.
Thanks, Paul. Thanks, everyone.